While the new tax regime was introduced in FY21, Union Budget for FY24 revived it. The tax slabs were revised, the rebate under Section 87A was extended up to 7 lakh rupees of income, the benefit of standard deduction was introduced in the new tax regime as well, and above all, the new tax regime became the default option. Now, under the new tax regime, there is no tax if your annual income is up to 7.5 lakh. There is even a marginal relief for income from 7.5 lakh to 7.78 lakh. So, for this income range, the tax will be the amount exceeding 7.5 lakhs, not the amount as per the tax slabs. All these motivated many of us to opt for the new regime. But there was a compromise too. We had to give up almost all the deductions and exemptions we enjoyed in the old tax structure. Of course, that made things simpler and straightforward and helped us get rid of piles of documentation. Not to forget, it gave us the flexibility to decide where we should put our money to work. But the desire to save some tax is very much there, isn't it? And why not? It's our hard-earned money. So the question that many of us who opted for new tax regime have is this: is it possible to save taxes in the new tax regime? Hello and welcome to ET Money's YouTube channel. Today, we will discuss how you can save tax if you have opted for the new tax regime. But before we begin, a quick reminder. You are watching this video on ET Money's English channel. हमारा एक हिंदी चैनल भी है जहां पे आप सारी वीडियोस हिंदी में देख सकते हैं. And if you are or know somebody who wants to understand the basics of finance, we have a channel called 5 Minute Finance where we explain the basics in under 5 minutes. Do check them out. Alright, let's get back to our video. Well, honestly, there aren't many avenues in the new tax regime, and they are much fewer than those in the old tax regime. Still, it is worthwhile to know them so that you can use them if possible. So let's begin with the tax saving options in the new regime. Do watch this video until the end so that you don't miss out on a worthy option that can save you thousands of rupees. Most employees have PF deductions. These include 12% of the basic salary contributed by the employee with another 12% contributed by the employer. For example, if the basic salary is 20,000 per month, 12% of it, that is 2,400, is contributed by the employee and another 2,400 by the employer. Now, there is no tax on the 12% employer's contribution both in the new and old tax regimes up to the contribution of 7.5 lakh rupees in a financial year. In other words, while the employer's contribution is part of your CTC, it isn't part of your taxable income. Whether it's old or new regime, this aspect remains the same. But note that the employee's contribution of 12% is part of the taxable income. It is tax exempt under Section 80C in the old tax regime, but not in the new one. Similarly, an employee's NPS contributions under Section 80CCD2 of up to 10% of basic salary are tax exempt both in new and old tax regime, subject to the upper limit of 7.5 lakh rupees in a financial year. So if the basic salary is 20,000 per month, that equals to 2,000 per month or 24,000 for the year. You can ask your HR to opt for the employer's NPS contribution under Section 80CCD2. However, your employer may not allow it at the end of the financial year, so you can get started from the next financial year. Let's talk about the next tax saving avenue now, and this is an important one. Under Section 24B of the IT Act, interest on the home loan taken for a property that has been let out is deductible from the rental income. This feature is available both in the old and the new tax regimes. So, this deduction effectively reduces the net rental income, thus reducing the tax outgo. Let me explain this in detail. The home loan EMI you pay has two components, the principal and the interest. The principal repayment is tax deductible up to 1.5 lakh rupees in a financial year under Section 80C in the old tax regime. Now, this deduction is not available in the new tax regime. The second component, which is the interest, is tax deductible depending upon the end use of the property. So let's first talk about the self-occupied property. If the property is self-occupied and you have received its possession, you can claim a deduction on the interest paid up to 2 lakh rupees in a financial year. But this is possible only in the old tax regime and not in the new one. So, if your house is self-occupied, you can't avail any tax deduction under the new regime. Alright, next comes a let out property. If you finance your home purchase with a loan and you have let it out, you can claim a deduction for the interest paid under both old and new tax regime. In other words, if you are a landlord who has bought a house on loan, you can avail of interest deduction under both old and new tax regimes. The interest paid will be adjusted against the rental income, which will lower the net rental income on which you need to pay tax. Now, apart from the interest, one can also claim the standard deduction of 30% of the net annual value of the property. This net annual value is derived after deducting municipal taxes from the gross annual value. Let's understand this with an example. Say you have a property that you purchased with a home loan. The interest component of this loan is 2 lakh rupees for FY24 and you gave this property out on rent at 25,000 per month. So your gross annual income from the property is 3 lakh. After reducing the municipal taxes, we get the net asset value. We have assumed the taxes to be 10,000 rupees for FY24. The deduction of 30% is deducted from this net asset value. After that, the interest on the home loan is deducted. That leaves us with just 3,000 rupees. So only 3,000 is subject to tax. Now, after adjusting the interest and standard deduction, if there is a loss, you can't set off this loss against other incomes under the new tax regime. Neither you can carry it forward. In effect, you aren't compensated for a net loss on the rental property. But what if the property is vacant, that is neither rented nor occupied? Well, you can claim a nil annual value for up to 2 houses. So if you live in one house and the other one is lying vacant, that's not a problem. However, if you have more than 2 houses and the additional house is also lying vacant, you will have to include the deemed rental income from the house in your tax calculations. So you will have to consider it let out for taxation purposes even when it's not. Now, based on the rental income from a similar property, you will need to calculate the rental income and pay tax on it. Now, all of this can be confusing, but that's how it is. If required, you can get help from a qualified tax professional when making these calculations. Alright, let's now move to the next type of tax benefit available in the new tax regime. Many companies offer a host of reimbursements in the CTC that an employee can claim by producing the required bills and proofs. These include reimbursements for fuel and travel, driver's salary, home or internet, books and periodicals, etc. You can save tax by opting for these reimbursements. They are not subject to tax under both the old and new tax regime, provided you present the bills and the proof. In the absence of the required proofs, your employer will subject these to taxes as applicable. But do note that these reimbursements are not given outside your CTC or salary. It's your salary that is structured to include these reimbursements. So if you don't present the required proof, you will have to pay tax on that part of your salary. Now, these items are tax-free under the new regime because they are configured as reimbursements and not deductions or exemptions. These are expenses that you made for your employer as part of your work and your employer reimbursed you for them. You can talk to your HR or accounts department regarding these reimbursements, or you can take a look at your employment offer letter. It often mentions the detail. Alright, let's now take a quick look at some of the other tax-saving avenues in the new regime. So we have discussed the main tax benefits available in the new tax regime. There are a few others, but they are pretty specialized and subject to certain conditions. I will list them out for you. If any of them applies to your case, please dig deeper. Talk to a tax advisor if required. Number 1, a deduction of 33.33% or 15,000, whichever is less, on family pension. Now, family pension is the pension a family member receives after the pensioner's death. Number 2, gifts of up to 50,000 rupees. Number 3, gratuity of up to 20 lakh rupees under section 1010. Number 4, an amount of up to 5 lakh received in the case of voluntary retirement under section 1010C. Number 5, leave encashment amount of up to 25 lakh rupees under section 1010AA. This is applicable at the time of leaving the job, not while you're still with the company. Number 6, allowance for tour, travel or conveyance for official purposes and transport allowance for the specially abled. Number 7, daily allowance if the place of work is different from the usual one. Number 8, certain non-taxable prerequisite for official purposes such as company provided laptop, medical facilities, interest-free salary loan, etc. So these are the some ways in which you can save tax in the new tax regime. But there is one case where your new tax regime can actually be bad for you. Let's see it now. In order to simplify taxation, the government will likely be pushing the new tax regime. For a taxpayer, the new regime is more convenient too. But there is an important caveat here. In the new regime, it's the taxpayer's responsibility to save and invest. There is no tax being pushed from the government. So it's better suited for those who can manage their investments and insurance on their own. However, if external push is necessary for you to invest and save, don't be tempted by the new regime. Despite its complexities, the old regime would still be better for you. So choose wisely. And with this, we have come to the end of this video. Hope you liked it, and if you did, don't forget to like, share and subscribe. And I'll be back soon with another video. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.